As of the close of regular trading on Friday, June 26, 2026, at 4 p.m. EDT, Navitas Semiconductor stock, trading under the ticker symbol NVTS on the NASDAQ, stands at exactly $17.30 per share, marking a minor drop of 0.23% in its final session of the week. This stabilization comes on the heels of a bruising multi-day rout that saw the stock shed massive value from its recent peaks. While a casual glance at a retail trading application might suggest this is just another volatile small-cap chip designer getting knocked around by macroeconomic waves, the real situation under the surface is far more complex. The hidden catalyst driving this intense trading volume is not just a general pullback in technology assets, but a massive $500 million at-the-market equity offering that has triggered severe dilution anxieties among major funds and everyday retail investors alike. When people look at high-growth tech firms, their primary expectation is often that explosive technological adoption will immediately translate into a soaring share price. Investors see partnerships with giants like the designer of the famed NVIDIA stock and assume the financial road ahead is smooth. The reality, however, is a harsh lesson in capital structures and corporate balance sheets. Navitas has been burning through cash to scale its manufacturing partnerships and build out its pipeline for high-voltage power architectures. This means that while the product demand is surging, the business has been forced to dilute existing shareholders significantly to keep the lights on and fund its expansion. This stark contrast between incredible commercial interest and severe structural dilution is exactly why the stock has been experiencing massive double-digit daily swings, confounding those who engage in self-investing without looking at the corporate filings. To establish some common ground, it is easy to see why the market was incredibly bullish on this name just a few weeks ago. The mainstream consensus was that the frantic race to build out power-hungry artificial intelligence data centers would create an insatiable demand for high-efficiency power semiconductors. This belief propelled the asset to a spectacular 52-week high of $34.17 earlier this summer. Millions of individuals practicing online investing added the company to their watch lists, viewing it as a pure-play option on the physical infrastructure of the modern cloud. But our contrarian take requires looking at the actual valuation multiples. At its peak, the business was trading at a jaw-dropping multiple of roughly 90 times forward enterprise value to revenue. That is an exceptionally steep premium for a company that is still reporting net losses. When the broader market began to question whether infrastructure spending was pacing ahead of near-term consumer demand, that premium evaporated rapidly, driving the price down toward its current $17 level. Recent stock movements highlight just how sensitive this asset has become to sector momentum and institutional shifts. During the final week of June, trading volume exploded far beyond the daily average of 25 million shares, hitting over 32 million shares in a single session. This massive liquidity event coincided with reports that global semiconductor supply chains were adjusting production schedules for next-generation hardware. When major international suppliers hinted at a temporary cooling in component orders, highly sensitive growth stocks were the first to feel the squeeze. For an investor managing an individual brokerage account, these swings can be stomach-turning. The price action was further amplified by a notable transition in the chief financial officer role at Navitas, an event that always causes institutional compliance departments to pause and reassess their models. If you look at how modern market participants interact with the stock, the ecosystem is highly fragmented. Many retail buyers utilize a Robinhood app or a simple Fidelity mobile app to participate in fractional shares, drawn by the low nominal stock price and the high beta. On the other end of the spectrum, sophisticated allocators utilize specialized platforms like Interactive Brokers Trading to manage complex option strategies or hedge their exposure. Meanwhile, long-term wealth advisors might filter this name into automated models or platforms like Schwab Intelligent Portfolios, balancing it against larger, more stable components like Apple stock or Tesla stock. No matter which channel is used, the central point of friction remains the same, which is how to value a specialized component supplier that boasts 50% sequential growth in its high-power data center segment, but still reports an earnings per share loss of 15 cents in its latest quarterly numbers. Comment below how many shares of Navitas Semiconductor you currently hold in your portfolio. Understanding the business model helps clarify why this friction exists. Unlike traditional legacy chipmakers that rely on silicon, Navitas specializes in next-generation materials, specifically gallium nitride and silicon carbide. These materials allow power management systems to operate at much higher voltages, lower temperatures, and faster switching speeds. The commercial applications are broad, stretching from the fast chargers you use for your consumer smartphones to the intricate 800-volt power systems required for electric vehicles and heavy industrial machinery. In theory, this positions the enterprise at the center of multiple secular growth trends. When someone looks for investment help to build a forward-looking basket of assets, next-generation materials are almost always highlighted as a critical subsector. However, looking back at past performance reveals a persistent gap between technical milestones and financial self-sustainability. In the first quarter of fiscal year 2026, the company reported total revenue of $8.6 million. While that figure actually managed to beat conservative consensus forecast by about 5%, the underlying net loss widened to $27 million for the period. Operating cash flow remained negative at $16 million. For a self-directed trader reviewing data on various investing sites, these metrics demand a careful balancing act. The company holds more cash than debt on its balance sheet, which provides a comfortable safety net, but the $500 million at-the-market equity facility proves that management is highly aware of how quickly cash can vanish when scaling up deep tech manufacturing. This brings us directly to the future outlook and the potential scenarios that could unfold over the remaining quarters of 2026 and into 2027. The most immediate catalyst to watch is the upcoming earnings report in early August. Management has guided for a significant ramp-up in revenue, pointing to a healthy pipeline of customer designs entering active production. If the company can prove that its power architectures are securing definitive slots within the hardware blueprints of major cloud service providers, the stock could easily stage a powerful relief rally. Institutional owners such as the Vanguard Group, which holds over 6% of the outstanding shares, and Goldman Sachs, which maintains a smaller position, will be watching the gross margins closely. If margins expand, it proves the company has pricing power. If they compress, it suggests that larger legacy competitors are successfully undercutting them on price. Conversely, the downside risks cannot be ignored by anyone engaged in online investment. The shadow of the at-the-market stock offering will continue to cap near-term upward momentum. Whenever the stock attempts to mount a sustainable rally, the market expects the company to tap that equity facility to shore up its balance sheet, effectively creating a ceiling of overhead supply. Furthermore, if high-end hardware spending slows down across the broader technology ecosystem, specialized component players with rich valuation multiples are typically penalized the most. A retail investor managing a retirement portfolio through Fidelity Investments or SoFi Investing must recognize that Navitas operates with a very high beta, meaning its upward moves are thrilling, but their downward corrections are often swift and severe. When evaluating options across different investing sites, it helps to contrast Navitas with the broader choices available to modern capital allocators. A conservative investor might prefer to hide out in broad market funds like Fidelity ETFs, diversified Fidelity mutual funds, or automated models via an intelligent portfolio that minimizes single stock exposure. Others might choose to focus their capital purely on mega-cap market leaders, buying blocks of Tesla stock or Apple stock because of their massive free cash flow cushions. But for those who intentionally seek out high-risk, high-reward opportunities within an individual brokerage account, Navitas represents a pure bet on the material science underpinning the next decade of power infrastructure. The core question is whether you believe the current $17 entry point appropriately discounts the dilutive risks, or if the valuation still remains detached from fundamental realities. Looking closely at institutional positioning provides another layer of critical context. Right now, public companies and retail investors control roughly 50% of the floating stock, leaving the remaining half in the hands of mutual funds, exchange-traded funds, and hedge funds. This balance split explains the highly erratic nature of the daily order flow. On days when retail optimism runs high on the Robinhood stock trading platform, we see sudden, sharp spikes driven by momentum chasers buying up fractional shares. On days when institutional risk managers decide to trim their small-cap technology exposure, large blocks of shares move through Interactive Brokers platform channels, quickly overwhelming the retail buy orders and causing steep drops. This constant tug-of-war emphasizes why navigating this specific asset requires a clear understanding of market mechanics, rather than relying on emotional narratives. To summarize the central insights of our analysis, Navitas Semiconductor finds itself caught in a classic structural disconnect. The expectation held by the market was that companies' advanced gallium nitride and silicon carbide solutions would ride a wave of unhindered growth straight to structural profitability. The reality is that building out an advanced component business is an incredibly expensive endeavor that requires repeated dilutive capital raises, a reality that has brought the share price down from over $34 to $17.30. While the sequential growth in data center demand is entirely real, the financial runway required to reach net profitability is longer and more expensive than many early buyers anticipated. By looking past the superficial product type and focusing on the underlying cash burn and equity dilution, investors can make vastly more informed decisions, whether they are executing trades on a SoFi trading platform, managing an integrated Fidelity brokerage account, or adjusting their long-term allocations within a comprehensive asset management framework. Authority in the market is built on respecting the numbers, and for Navitas, the numbers say that technical success must eventually pave a clear path to financial sustainability before the market will grant it a permanent valuation. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly. Thank you for liking, commenting, and sharing this video to support the channel.